Corporate income tax is designed to take a percentage of your profit. It is a deliberate friction placed on your bottom line. But a value-added tax, like the GST, operates on a completely different architecture. For a registered business, the Goods and Services Tax, or HST, is not a business expense. When executed correctly, the operational net cost of this tax to your company is exactly zero. That is the bedrock axiom of a value-added tax system. The entire mechanism is engineered so that the ultimate consumer, and only the consumer, bears 100% of the financial burden. The government allows very small operations to act as consumers, exempting them from the system. But the threshold to qualify as a small supplier is $30,000 in revenue, a limit that has not been adjusted for inflation since the tax was introduced in 1991. Once you cross that threshold, your relationship with the government shifts. You are no longer a taxpayer in the system. You become a mandatory, unpaid administrative agent of the Crown, tasked with collecting and remitting their revenue. Misunderstanding this flow-through mechanic does not excuse you from the liability. It simply means you accidentally absorb the Crown's tax burden directly into your own operating margins. To see how a business achieves that zero net cost, we have to look at how the government taxes a multi-stage value chain without double taxing the businesses in the middle. This diagram shows a standard linear supply chain. We have a manufacturer producing goods, a wholesaler moving them, and a retailer selling to the final consumer. Let's isolate the wholesaler. They purchase $1,000 of inventory from the manufacturer. At a 5% rate, the wholesaler pays $50 in GST on that purchase. The wholesaler marks up the product to $1,500 and sells it to the retailer. On that sale, they charge and collect $75 in GST. This is where the input tax credit, or ITC, activates. The wholesaler is allowed to claim the $50 they originally paid as a credit against the $75 they collected. They remit only the $25 difference to the Canada Revenue Agency. Look closely at the math. The wholesaler added $500 of value to the product. 5% of that $500 gain is exactly $25. The tax remitted matches the exact value added at that specific stage. Through a flawlessly executed ITC system, the business acts merely as a conduit, passing the tax along and bearing zero net cost. That perfect flow-through loop only holds together if the government categorizes your specific product or service as a qualifying supply. Most commercial operations provide what are called taxable supplies. In this standard category, you charge the full GST or HST rate on your sales, and you are entitled to claim input tax credits on the expenses incurred to generate them. A haircut at a local barber shop is a fully taxable supply. The barber charges tax to the customer and claims ITCs on rent and utilities. Then there is the zero-rated anomaly. These are items where the government sets the applicable tax rate at exactly 0%. You don't charge the customer any tax, but you maintain your status in the flow-through loop, meaning you can still claim full ITCs to recover the tax paid on your expenses. Basic groceries, like raw meats, vegetables, and milk, fall into this zero-rated category. This is vastly different from exempt supplies, which includes things like residential rent or financial services. With exempt supplies, you also charge no tax to the customer, but you are strictly locked out of the ITC system. Any GST you pay on your overhead is permanently lost. If you miscategorize your output, what should be a neutral flow-through instantly becomes a hard, unrecoverable operational cost. For early-stage founders, the requirement to join this system is hidden behind a $30,000 threshold. The common, dangerous assumption is that this limit is tied to a standard calendar year. It is not. This chart maps the cumulative sales test. Instead of looking at January to December, the CRA evaluates your revenue over any 4 consecutive rolling calendar quarters. Let's look at Lay, a sole proprietor with steady growth. By the end of the third quarter of 2022, her rolling 4-quarter total reaches $31,000. Under the cumulative test, she gets a brief grace period. She loses her small supplier status at the end of the month following that quarter. She must register by October 31st and begin collecting tax on November 1st. Now compare that to the alternate rule, the sales and quarter test. Here is Vince's data. His business has been essentially dormant, generating almost zero revenue for a year. Then, in a single quarter, he completes a major project and issues one invoice for $35,000. Because Vince breached the threshold within a single calendar quarter, the grace period is voided. By law, he loses his small supplier status immediately before that transaction occurs, and he is required to charge GST on that exact invoice. If you issue an invoice without charging the required tax, the CRA will not look to your client. They will retroactively demand the uncollected amount directly from you, forcing you to pay the missing tax out of your own pocket. The tax code contains structural asymmetries. Agile founders can use these specific rules to decouple their mandatory tax remittance from their actual expenses. This split-screen ledger compares the standard reporting system with the quick method. Available for certain businesses with under $400,000 in revenue, this election replaces the tedious tracking of individual input tax credits with a single flat remittance percentage. Let's input the data for an IT consultant. They generate $248,600 in total revenue, which includes the 13% HST. They have $44,748 in operating expenses, and they spent $3,390 on capital hardware. Under the quick method, we ignore the operating expenses entirely. Instead, we apply a predetermined flat rate, in this case 8.8%, directly to the total eligible revenue, giving us a subtotal of $21,877. Next, we apply the statutory deductions allowed under this method. We deduct a 1% exemption on the first $30,000 of supplies, saving $300. Then we claim the standard ITC for the capital hardware purchase, subtracting another $390. That brings the final net HST remittance owed to a government down to $21,187. Here is the asymmetry. The consultant actually collected over $28,000 in HST from their clients at the standard 13% rate. By utilizing the quick method, they remit $21,000 and legally pocket the difference. By leveraging this method, a service business with low overhead legally converts a rigid tax collection mechanism into a highly efficient vector for operational profit. Managing a value-added tax system requires you to control three distinct levers: precise supply characterization, vigilant threshold tracking, and strategic remittance optimization. This framework is not a suggestion. It is a mandatory collection protocol enforced by the highest legislative authority in the country. If you fail to execute these duties, you trigger director's liability. In cases of unremitted trust funds like the GST, HST, the Canada Revenue Agency holds a unique overriding power to pierce the corporate veil. If your corporation dissolves or simply fails to remit the tax it owes, the limited liability shield vanishes. The government will hold the corporate directors personally, jointly and severally liable for the entirety of the tax debt, plus interest and penalties. Tax compliance is not an administrative afterthought you can blindly outsource and ignore. It is a dynamic, operational imperative required to protect your personal assets from the obligations of the business.